This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
Welcome to The Interest. I'm Mike Savino. Do you work with powerful, trailblazing women in the mortgage banking industry? Well, it's not too late to get them the recognition that they deserve. Friday is the last day to submit nominees to be named a powerful woman in mortgage banking, celebrating women who've risen to the top of the industry, especially those working in finance, technology, the C-suite, places you might not normally expect to see a lot of women. We're also looking for those who are great mentors for the next generation. Self-nominations are welcome, and you can submit nominations by visiting nationalmortgageprofessional.com. Selectees will be notified at the end of August and will be featured in the October issue of Mortgage Banker magazine. In other news, Fannie Mae is forecasting real GDP will increase by less than 0.1% this year and then decrease by 0.4% next year. The Fannie Mae Economic and Strategic Research Group now predicts a recession will begin in that first quarter of 2023. But the group is also predicting that inflation will drop from its current 9.1% down to 5.7% in the final quarter of this year. With inflation running well above the target rate, the market's expectation that further substantial monetary tightening policy is needed has driven interest rates even higher, and interest rate-sensitive sectors, including housing, are slowing in response. We continue to see more warnings about a recession. Just today, the MBA says it's now a coin flip whether or not the economy will shrink. And a growing number of experts are saying with confidence that there will be a recession.
To me, the big question is how deep it's going to be. I'm really hopeful it's going to be a fairly mild recession, especially since we're starting with such a high level of employment and such a low level of unemployment.
And speaking of Fannie Mae, the entity and Freddie Mac still have a long way to go to meet their required reserves. FHFA Director Sandra L. Thompson told the House Committee on Financial Services Wednesday that the government-sponsored entities are required to have $300 billion combined in capital reserves. As of today, they're only at $83.5 billion. The hearings came as Republicans want Thompson to be more proactive in overseeing Fannie and Freddie. A group of 10 Republican committee members recently sent a letter expressing concern that the entities are undercapitalized and engaging in behavior that puts the entire housing finance system at risk. Thompson says that the FHFA is taking steps to make sure that Fannie and Freddie's books are sound, including incentivizing the agencies to transfer more risk to private firms.
Everything that we are doing is going to be undergirded by safety and soundness because their financial condition is so important to us in making sure that what happened before doesn't happen again.
Thompson also highlighted other steps taken to strengthen the two companies, which have been in conservatorship since the 2008 crash. Those steps include ensuring that the enterprises are purchasing mortgages with fundamentally stronger credit quality and moving away from the riskier business models used prior to 2008. Republicans also asked if Fannie and Freddie could get out of conservatorship once their reserves reached that $300 billion mark. Thompson said other agencies, like the Treasury Department and the Federal Reserve, would still need to weigh in on Fannie and Freddie's policies, and ultimately, Thompson noted, the question about conservatorship rests with Congress. And finally, a second group of investors is now suing Zillow, accusing the company of hiding information on the risks associated with its iBuying operation. The shareholders in this new lawsuit claim that they lost $1.2 billion on Zillow offers, which Zillow shut down earlier this year. They claim that the company essentially was sacrificing the money it had available for renovations in order to buy up more inventory, and that caused issue with contractors. The result was that contractors could no longer earn a profit and began declining jobs. Then, without enough contractors to complete the renovations, Zillow's homes remained idle. As the inventory wasn't moving, this increased the cost of the program to the company. In October of 2021, Zillow announced a moratorium on new contracts in the Zillow Offers division, and by November, it announced that Zillow Offers had lost $400 million. Earlier this year, the company reported an additional $880 million in losses from the Zillow Offers division. A separate group of investors has filed a similar lawsuit. Zillow asked a judge last week to dismiss that case, saying that they were upfront about the risks. And they also claimed in the dismissal that the request that security laws do not insulate investors from losses caused by unforeseen downturns. The judge in that case has not ruled on that request.
This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.